Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So we had another constructive week in the market as we see some sectors fall to the wayside. We have others coming to pick up the slack. We're obviously in the heart of earnings season. Had some big reports after the close yesterday that I'm going to talk about, a couple before the open today also. But in general, we've seen, as Scott has mentioned previously, we've seen a lot of companies falling short on revenues while beating on earnings per share. And that has been good enough for some companies that maybe hadn't run very far into their report and weren't extended or weren't well on highs. But for other companies, like we saw after the close yesterday, those revenue misses have not boded well, and they've led to sell-offs in stocks that were really strong heading into their reports. But like I said, as you've seen tech have some weaker reports and have some revenue misses in that sector, you've seen other sectors like oil stocks, like things like that, refiners really perking up and picking up the slack. You have banks resuming some leadership, which I'll talk about. But overall, the market remains very constructive. It's all about the Fed still. Earnings season, people place a little bit of emphasis on it, and since the financial crisis, earnings have been a strong point for the market as cost cutting and things like that have allowed companies to keep their balance sheets healthy. But the Fed still is driving the action in the overall market. And I think that's going to be the case until their September rate decision, when many people expect them to begin the QE taper. That'll be a very interesting event to watch, and I think the market could remain very choppy in August up until that September announcement. But we'll take a look at the chart of the spider right here. Spiders right here just to give you an idea of the action. Like I talked about, we had those all-time highs yesterday, and we've hung around again today with a nice strong close. We'll go to the SPX because the SPY went ex-dividend, so you don't have the same exact proportions there. But as you can see on the S&P, yesterday the all-time highs, we closed a little off the highs, and then today we gapped down, and we were able to close that gap and finish positive. No new highs today. Save your balloons, but still constructive, very constructive action, despite some lukewarm or mediocre earnings reports, I should say, after the close yesterday. And there's no real levels to watch because we're on the highs, but I'll go over a few of those stocks, the reported earnings, just to give you an idea of where they finished today. The first one is Google, which came out with a mediocre report, I would say, after the close yesterday, especially considering where the stock was, the move it's made this year. It was pricing in a very strong report, and that's not what we got. But investors took this dip after hours yesterday as a buying opportunity in Google. As we walked in this morning, it was much higher than it was after market yesterday, and then it continued higher during the session. We're going to take a look at the chart. Google finished the day down less than 2%, so healthy bounce back. And what you don't want to see on a gap down is a gap down and go to the downside, which can lead to a prolonged period of weakness for a stock. But Google was able to prevent that bounce, which puts it in the game potentially to get back to highs. And I think everyone's pretty much is extremely bullish on this stock right now because of all the different things they have going on, from their search revenues, from Google Glass to self-driving cars and all that type of stuff. The future looks very bright for Google in a number of different business segments, and I think people can't get their hands on enough right now. And I don't think we're going to get that rotation. People talk a lot about Google and Apple moving sort of in lockstep. We saw people piling out of Apple over the last year and potentially piling into Google. And I read a couple articles this morning where people were hypothesizing about maybe a reverse of that trend where people might start piling out of Google and into Apple, but I don't see that happening. I'll also take a look at the chart of Microsoft. Get a sip of water here. Microsoft was down big today, and that feared gap and go to the downside was what happened to Microsoft today as it finished down about almost 12%. It actually closed a little bit off the low, so I think it might have finished down around 11%, but in general, not healthy action for Microsoft. Gap down below this support pivot right here, which was going to be a crucial level for it to try to hold during today's session, and it was not able to hold that. It was able to salvage a little bit by closing back above the 200-day moving average, but still very unhealthy action for Microsoft that could lead to a prolonged period of choppy and bearish type action. And there's not a ton of support besides that 200-day moving average, which will be important to watch next week. If you're a holder of Microsoft, there's really not a lot of support until even down towards the $30 area. So a big red flag for Microsoft. They had that big write-down on their Surface tablet, one of their lower-end Surface tablets, and that was a big reason for this sell-off. And they're not really able to get a lot of traction in these segments like smartphones and tablets and these things. They're trying to compete with the Apples and to a lesser degree the Googles of the world, but they're trying. You can't fault them for that. I think they need a little bit of a leadership shakeup if they're really going to change their MO as a company right now. They're not really an innovator. The same ideas they've been trying to use for a long time aren't working, and even their new releases of obviously Microsoft Office, their core product, those have been mediocre over the last several years. So something needs to change for Microsoft. It made a nice run as people were looking for places to get yield and potentially get some upside in tech with Microsoft, but right now the rally is over for now, and it's wait-and-see mode for Microsoft. And then GE, on the flip side of those two, had a really nice report before the open this morning, and it looks like GE is set for a big resurgence after multi-year sell-off in that stock over the last even decade. But they have some new stuff in the pipeline. If you read our blog religiously, you saw a write-up we did about the industrial internet and how GE is leveraging that, and even one of the leaders in pursuing the industrial internet to try to create better efficiency among its production and some of its systems. So I think that's a big thing to watch, a big trend to watch over the next several years that GE could benefit from in a big way. Take a look at the chart of GE. You can see that big. It closed off its highs a little bit, but still really healthy action today with the gap and go. Broke above this pivot high. This is one that I don't own it long term or anything like that, and I'm sort of kicking myself for it because, you talk about time frame alignment. Yeah, it's had a tough go of things over the last, 5 years or so. It hasn't really recovered from the depths of the financial crisis the way that a lot of companies have, but you see it's slowly working its way back up from those lows, the market lows in March 2009. It's been in a steady uptrend, but it hasn't, performed and gotten back to those previous highs as fast as some other companies have. But I think this one's really improving a lot. Like I said, if you talk about monthly moving averages, it's back above obviously it's 8-month, it's 21-month, it's 50-month, and it climbed back above its 200-month. So on a larger time frame, things are definitely improving for GE, and I think this one has a lot of upside in store due to some of the things I was talking about with the industrial internet, and their margins keep improving, and they could potentially hike their dividend, all things that are extremely positive for the company, and I think they've really turned things around and are on the right path. So today, really constructive move, and I think could be the beginning of a nice multi-year run potentially for GE. Chipotle, another good earnings report. That company, everybody keeps waiting for the day that it finally falters and has that macro pull-in, sort of what you saw with something like Netflix. I mean, Chipotle is a lot different business than a Netflix, but they're both lumped in the same category over the last few years due to the fact they traded a high multiple compared to some of their peers, and people don't think they could sustain the type of growth that they've been having, but Chipotle continues to prove the doubters wrong and had another great move today. It was up around 8% on those earnings, back on its way, it looks like, potentially towards highs. It has a nice cluster of support here, or a cluster of resistance, up here around the 420 area. So I think that could be the next stop for Chipotle. A little bit hard to chase after a gap and go to the upside today. Potentially you wait for a little bit of digestion, a little bit of a base before trying to play Chipotle now. But it's one that I think will continue to, prove the doubters wrong and make a move potentially back up toward highs. But that'll wrap it up for the group of stocks that reported earnings after the close yesterday and before the open today. And we'll get into a little bit more sector analysis now. A big theme so far this earnings season, like I said, you've had some tech stocks that have been weak on revenues, and you've had some sell-offs like an eBay, like a Google, like a Microsoft. But you've had other sectors pick up the slack. Like I talked about, oil stocks have gotten stronger, and then the banks have been really, really impressive from a fundamental perspective with their earnings numbers, and then also their reaction to those numbers, basically proving that those beats weren't priced in, the whisper numbers weren't higher than the actual numbers. And I think the banks could provide some leadership for the market if it's going to continue to make new highs and continue to trend higher. So we'll take a look at my two favorites are Wells Fargo and JP Morgan among the banks. And I'm not talking about short term. The technicals are good on both of those, but I think even long term, those are my favorite companies among the financial sector. And I think the stocks reflect that to a certain degree on multiple time frames. But we'll take a look at Wells Fargo, which I'll just go ahead and deem my favorite among the banks. Continues to have really constructive price action, broke out to new highs late June, continue to trend higher. Nice earnings report, nice dividend yield on Wells Fargo. They don't take a lot of the outsized risk that a lot of the other companies in the sector do, and that's a positive thing to me. It's something, if you're going to put a bank stock in the drawer, that's something that you want to see. You go ahead and take a look at the chart of JP Morgan. The other one that I really like in the group, I'll go back to the chart of Wells Fargo for you right quick there, because I don't know if you got a chance to see it. But today it was put in a doji candle, which is a little bit of an indecisive candle, but I don't think that necessarily tells you a whole lot. I think the market was quiet today. It was a summer Friday. I think that's a natural thing to see. JP Morgan, it opened higher today, wasn't really able to get any more momentum, but a retest of this prior breakout level is healthy, and I think this will be a group leader going forward. It obviously worked through the London Whale situation, Jamie Dimon potentially leaving, all those issues, and it's sharply higher since all those things. It sort of goes to show you also that when you get these headlines in the banks or other sectors also, you talk about like the BP oil spill as it related to Transocean and BP, those are all issues that are resolvable if over a long enough time frame. Obviously, in the short term, the first day when some big news like that comes out, you don't want to be buying immediately, but as you start to get a little bit more clarity on those situations and the stock starts to actually move up when bad news is released, which is what you saw in JP Morgan. When they released the final tally of the losses from the London Whale, JP Morgan traded sharply higher from that. I can't remember the exact date, but it's just a lesson in longer term trading, is that on news events that are isolated, like a London Whale, like a trading loss or something like that, you can potentially look to buy weakness on that news, because it's not going to hamper long term a company like JP Morgan that's financially sound, and all their house is in order for the most part, if you can say that about our financial system in this country. But a great opportunity there in JP Morgan, and now it's on highs, and I think it could continue to lead the banks. But we'll take a look at a couple more. Morgan Stanley was one of the ones to report this week. Yesterday it gapped up big, held that gap. Today pretty much it held the gap also, put in another doji candlestick, which is healthy action to see. Gap and go is obviously better, but you can't really fault it after a big gap up like that for not having for not having more momentum. I think it's healthy to see that, and if it continues to digest above this gap, you could get another add-on entry potentially above those pivot highs. Goldman Sachs starting to improve a little bit. I'm not in love with it. I know as a company it's considered one of the best banks in the industry, but the stock is not really cooperating with that thesis right now. I think it could improve and play some catch-up. If I were to have a third favorite in my group, it would probably be Goldman Sachs, in terms of a combination between understanding the fundamental or the prestige of a bank plus the price action. Some of the other ones have been a little bit stronger, but I still think you might get a little bit better risk reward with a Goldman Sachs. Then Bank of America has been strong, but I would caution against chasing that one. Citigroup has also played. It's a little bit like Goldman Sachs, actually. It's not to highs yet, so that's one that you could potentially have some room in. But like I said, JP Morgan, Wells Fargo, my favorite among the banks, and I think the banks could provide some leadership for the market, taking that mantle a little bit from tech, which was leading post QE Fed taper talk. People started to shift into riskier assets in tech, and now that the Fed has cooled that rhetoric a little bit, I think you could see things like consumer staples, things like banks continue to inch higher and help hold this market up. Biotech stocks are also providing some leadership and performing really well, and I'll go through three of those that I like the best. Biogen, BIIB, sort of went a little bit today. It's one that we thought about including it as Mark Sperling's trade idea of the week on Monday, but the biotech stocks are a little bit tricky because they're subject to news very often, and so I shied away from that one, but it's one that we've been discussing in the virtual trading floor. I think Mark has a long position in it. It went a little bit today, so it might be a little bit tough to chase, but I think you could see Biogen back at highs fairly soon, up in that 240 area. I think it's a quality biotech company. There's a lot of interest in acquisitions of these biotech companies right now that are coming out with all these drugs that are successful in solving various diseases. Biogen is one that's attractive to me. Celgene, another one, had a big gap up and held that gap, which is very constructive action to see. Yesterday it looked like it might break down a little bit, but it rescued it to get back in that upper range with a doji candlestick, and then today it ignited from that close yesterday, back up towards the upper end of that upper range. And these are the types of gap and consolidate type patterns that we love to see, and you could potentially get some juice on Celgene if it breaks above that pivot right here. The conservative entry would be 137.80, and aggressive entry would be right around here as it gets toward the upper end of that range. Celgene, and then ACAD, Acadia, another one that looks good to me. I know it's come a long way really fast from around $6 back in April all the way up to the $20 area, but it's another one that has a little bit of a cup and handle pattern forming. You see this cup right here, then you have the handle right here. With the biotech stocks, things can change with these companies really quickly based on drug approvals and things like that. So, yes, it has come a long way quickly, but with biotechs, you have to take that with a little bit of a grain of salt and understand that when momentum gets going in the right direction for these pharma stocks, it can lead to a big, fast move. And so I wouldn't be as cautious about chasing them. Yeah, they are subject to FDA approvals and all that type of stuff, but they can move quickly, basically the point I'm trying to make. And Acadia has a nice pattern, cup and handle pattern, so one to keep an eye on. We'll take a look at the OIH. One thing I've been mentioning that has been perking up and providing leadership to the market in the face of some weakness from tech. Today, a really nice extension from the OIH as it finished up almost 2%, breaking above this pivot right here back from mid-May. We can zoom out on OIH to see where it is. And it's still been in an uptrend from those market lows in 2009, but not as steep of an uptrend as you've seen in some other sectors, obviously. Same way I was sort of talking about with GE, but it has some room up to these pivot highs back from 2011, early 2011, late 2010, that based on the recent action, I think it could get up there. Some stocks in the group acting really well, and potentially a name that money could rotate into. It's breaking above this pretty important resistance area, so could see some momentum come into that. The GLD and the TLT, this is where I'll get into my Fed spiel about, everyone's sort of overreacting to everything the Fed is doing, but the Fed is driving the action right now, and it's something you have to be aware of. David Tepper made that thesis early on after the financial crisis, once the Fed made it clear that they were going to create a low interest rate environment and do things like QE. Don't fight the Fed. And as much as we want to talk about the negatives and the unintended consequences of what they're doing with QE and their unprecedented monetary policy, everything you have to do has to keep them in mind. As difficult as that is sometimes, it's about, do I want to make money or do I want to be right, as many people have talked about in the past. And obviously we want to make money in this business. So gold and TLT, I'll get back into the meat of what I'm supposed to be talking about here. Gold and TLT are both inching higher. Bond yields are coming back down a little bit. Bonds, TLT inching higher, and gold is inching higher as the Fed sort of backtracked from their more hawkish view that they expressed in the most recent rate decision. In the Fed minutes, it came out, and Scott and I talked about this in one of his morning notes. It was actually a morning note special edition that we sent out one afternoon about how it seems like the Fed chairman, Ben Bernanke, has carefully crafted his message for various purposes over the course of these rate decisions and Fed minutes. Basically, he, I think, sucked some leverage out of the bond markets. He sucked some leverage out of gold markets, or he punished some gold holders below key levels that we've talked about in gold. And he also saw the markets a little bit overheated, saw a chance to talk them down a little bit and maybe cool things off there slightly. And he did that, and then he changed his tune a little bit in the Fed minutes and went back to that more dovish tone about, oh, nothing's preset. We're not on any course. We don't know if we're going to taper. It's just something that we're talking about. We're still tying it to the job market and things like that. So a slight tone shift. Yeah, people are, making a little bit too much of every one of those rate decisions and Fed minutes, and they're dissecting every single word in those reports. But I still think you could get a snapback in gold and bonds leading up to that September rate decision. The September rate decision by the Fed is the one everyone's going to be watching. It's the one that everyone's targeted as the potential time that QE tapering could begin. And so in August, I think the market could be a little bit choppy. I think you could see a snapback in gold and TLT. We'll take a look at the chart, and I'll show you both of those have been inching higher. Gold, no real power. It's basically all gaps, which makes sense because a lot of the gold trading takes place in overnight trading. Pit closes at 1 o'clock, so you don't oftentimes see a lot of movement in gold after then in U.S. time zones. But a lot of gaps, not a lot of power intraday, and I think you could see that same type of inching higher type action in gold. Obviously, the big thing is this gap right here, and I really wouldn't be surprised to see a retest of this breakdown level up here at around the 130 area. So for gold, could keep inching higher. TLT, yes, long term, I think bond yields are going to go higher, and bonds are going to sell off because they've been so low for so long. But I do think we could see the TLT inch higher, close this entire gap from here, and get back up, to the $110, $111 area. I don't know how far it can go, but I think right now you could see that type of action in TLT and in GLD leading up to that September rate decision by the Fed. Another trend this week was you saw some Chinese internet names perk up big time. I'll go through these quickly. Baidu, really strong action this week. Sina, see that chart, really strong action Wednesday and Thursday in particular. Sohu actually looks like it might have some room, didn't go as big as the others. Kihu, just some examples of where else money is rotating while it's rotating out of some other tech names. And just some quick hits here, some ones we talked about and off the charts. MGM broke out yesterday, sort of held today. Constructive action, could see higher prices. CRM, a little bit of a mid-level base. We like to play stocks that are basing near highs, but you don't always get a perfect setup. And CRM looks like it's perking back up after a rounded bottom. Constructive flag here over the last week plus. If it breaks above that pivot around 43, I think it could get some more upside. WDay, one I pointed out on Twitter a few weeks ago, has been strong since then. It's back up here near pivot highs. I think today it looked like it might go. A little bit of a thinner, tricky stock, but I think it'll break highs. That's just my opinion, but I think it's going to do that. Tesla, obviously a volatile week this week. Broke down hard. People thought, oh, maybe that's the end of the Tesla heyday, but the next day snaps right back and then digests that snapback. So, with the big short interest still remaining in Tesla, I think you could see some more squeeze type action back up to that 130 area. I really do. Maybe it'll settle back down closer to that Goldman target around the $84 area. Who knows? But in general, I think people really want to own this one right now. And if there's any big dips like we saw earlier this week, I think people are interested in buying it. FSLR, which was Mark Sperling's trade idea of the week on Monday, just sort of hung around this week. Not the best action. It certainly wasn't like Netflix, which was his first trade idea of the week that hit its target within the first week. But it saw that gap up on Monday, and then just sort of digested. Yeah, we had a little bit of a descending channel for the week, but still above its 8 and 21-day moving averages, almost above its 50-day. Constructive action as far as I'm concerned in First Solar, and I think you could see it back at highs in the near future. But that'll about do it. I went over a lot of stocks today. Basically the theme right now is that the market's hanging out near highs. Despite that, there's not a ton of enthusiasm as people are waiting on the September rate decision by the Fed. You're seeing rotation through sectors that are allowing the market to hold up despite some mediocre earnings from various tech stocks, more on the revenue side. But in general, I think August could be a choppy month. Like I talked about, we wait for that Fed rate decision. But there is stock-specific action out there. Go in the virtual trading floor. Guys are doing a really good job of pointing out stocks that are in play and stocks that are moving. So if that's what you're looking for, if you're taking a shorter-term approach and you're looking for volatility, a great place to unearth those stocks is in the virtual trading floor, whether it be Mark Sperling and Scott Redler in the main room or the momentum trading room with Mike Lee and Steve LeVay. They had a great webinar last week going over some of their favorite patterns in the way they trade. So if you get a chance, it's posted on our homepage in the featured education section. So if you get a chance to watch that over the weekend and haven't, I would recommend watching that. Some really good education there that's free. But that'll about do it. We'll check back in with you on Monday, see if we get a little bit of momentum above highs or whether, like I said, we do get that choppy type of action in August. The dog days of summer, definitely possible. But we'll check back in with you next week and have a great weekend.